To escort our session chairman, C.A. Krishnan S. onto the dais. Now, I request our paper presenters to please come over to the dais. Mr. Nizam KP, Ms. Liana Fasin, and Ms. Chandra S. Nair.
I also would like to recognize the presence of the session judge, C.A. Deepakvi. A huge round of applause for all the dignitaries on and off the dais.
C. Krishnan S. is the managing partner of Rangamani & Co. Chartered Accountant. He has headed several organizations and has been involved in various capacities in social, cultural and educational fields. He was the chairman of the Alapi branch of SICASA of ICAI. He is the president of the Alapi Management Association, past chairman of Travancore Chamber of Commerce. He is the joint secretary of Income Tax Appellate Tribunal Bar Association, Kochi. He is an active Rotarian and whatnot. A huge round of applause and a very warm welcome to C.A. Krishnan S. May I now invite C.A. Krishnan S. to set a tone for the session.
Hand it over to Krishnan sir. I wanted to thank him. He has come all the way from Alapura. He's an expert on taxes, a guru, a mentor for many of us here. So, a lot of regards. Thank you, sir. Your presence is a blessing for us.
Good morning. Rather, good afternoon. I think already you are hungry. No good afternoon from your side. Great. Anyway, thanks Rupesh for this nice words of introduction. I think I just want to caution you that in my travel in this profession, I don't think you can become an expert as far as any tax law is concerned. With that note, to the organizers, the SICASA chairman, other distinguished members of the profession, my dear students. Indeed a great honor for me to be here as part of this mega conference. In fact, I envy all of you. This is something that we have missed during our student days. I'm happy that about 750 of you, I'm told that about 750 students have registered from across the state. And it's a great learning opportunity listening to many stalwart speakers, inventing something new in your journey in this very noble profession. And of course, I am here not as an expert or a speaker, but also as a learner because, our profession says that you keep on learning, rather unlearn and learn. Anyway, I think I should not be too much elaborating on my introductory remarks for the simple reason that we have three excellent speakers who have prepared and they are going to address you. And I think, in all fairness, we should give more time to them rather than me holding the mic for a long time. But having said that, the three topics that are going to be deliberated here are coined in such a way that, at one stroke you would think that some of them, what importance it holds today or what significance it has today. For example, tax planning for an individual in the present regime. So one look at it, probably you'll feel that, when all the things have been diluted, most of the deductions have been taken away, we are into a new regime with a lesser tax rate, with no significance for any deduction, where is the scope for any tax planning? You could think it that way. But look at it in a deeper sense, and you will find that still there is ample scope for tax planning. And that tax planning is just not, of course, the ultimate aim of a tax planning is to reduce your taxes. As far as an individual is concerned, he wants to minimize his tax burden. And that can be done probably, hitherto it was being done by investing, putting into small savings. But again, you all know that it is only a temporary phenomena because you are going to make an investment now, which will give you a tax rebate, which should ultimately turn into something more productive, and probably the interest or the return on that investment is going to make you pay more tax. So looking at it from one point, that tax planning that you are doing today is only temporary. Because going forward at some point of time, your taxable income is going to go up, and whatever you are going to do today is going to be a temporary phenomenon. But I actually, during many of my speeches or my address, I take live examples of the experiences that you have, there cannot be anything much better than that. For me, I have also done some tax planning at a time when I started paying income tax. But then the objective initially was probably to save tax, but going forward, there was another objective of tax planning, because this saving that you are going to make in the form of tax savings is going to help you in one way or the other as you go forward in life. For example, I did a tax planning for sending my son. I calculated that it was a calculated tax planning where I took twin advantage of putting into some savings which got matured. I timed it in such a way that it was handy for me to send my son for a higher education. So that planning is something it's with a goal. But nevertheless, it's a twin planning where you get an objective of a tax planning as well as you end up by using that funds at the appropriate time with a goal, so that it becomes handy at the most appropriate time. Now, we are into I wouldn't say crossroads, we are into a transition stage. Many of my clients ask me whether I should select the new regime or the old regime. Actually, at one stroke, I cannot give an answer because it will depend on suppose somebody has got a lot of funds available and he can make an investment, I'll have to calculate the taxable income, whatever it is, and then finally come to a conclusion whether which of the schemes would be better for him, provided the estimates that we are making at the beginning of the year is almost stable and it sticks on to the reality. Whatever estimates you are making towards the end of the year, that estimate is almost similar to what I have initially estimated. So the funds at disposal will probably decide what sort of a planning I can make. And then the necessity, for example, going forward today, one advice I as a chartered accountant give others is, if you're going to take a deduction, I think 80D is one of the best things you can take, because hospitalization is so expensive that it could erode one person completely. So coupled with the tax saving that you can enjoy in the earlier parts, it could be handy at the time when you are really in need of funds in the hospital. So there are so many factors that would actually determine the way in which you want to plan or structure your funds, so that you know what method you should use. And today we have a speaker who is prepared on this, so we have to listen to what sort of a strategy that he or she is going to adopt on that. Now that's as far as the first topic is concerned. The second topic is offshore investments and tax havens. These words should be familiar to most of you, but quite some of you may be wondering what is this tax haven or the benefits that you are going to get. We have been hearing about countries which have a very less tax. I will go to a simple, during our childhood, we were not exposed to tax and all those things. But we were exposed to something different, because somebody stashing their money in Swiss bank. And the government of Switzerland had a policy where they would not disclose the secrets or disclose the identity of the person who has deposited or whatever the accounts reveal. So that other governments who wanted to access that account, they were prevented from doing that because the law allowed them to do that. So by parking the money in those accounts at those point of time, today it is not possible, let me tell you. In those days, with the secrecy law of that country, it was difficult for any other country to solicit information from the government and then try to find out whether somebody has evaded the tax, because as far as a resident in India is concerned, the global income is taxable. So if you're going to put money outside India, the return on that is taxable. More than that, the source for the money that has been deposited outside India is a matter of concern for the government, whether it is legal money or illegal money. Now, countries which are considered as tax haven are generally having low rates of taxes. And there, it is legal for them, and their law also permit for them to do certain types of business. But the problem that arises is that it may be legal there, but ultimately going on the long run, it could lead to several disastrous consequences like illegal money getting into the system in a tax haven to be made into a white money later on. And it could also abet money laundering, which is a serious matter as far as the country is concerned. So that is one area area of danger that we have in tax havens. And today, with all the bilateral agreements the government are having, successive governments are having today, it is not easy for any country not to share any information with the other country. So as far as that issue is also concerned, a tax haven with the secrecy is something beyond your imagination, but still there are countries which are not that easily sharing information. Now, as far as the country which is receiving this is concerned, those are countries which are inviting foreign funds to them, and for a lesser tax rate, so those laws that are there will enable you to pay lesser tax, and to that extent those countries can augment funds from foreign resources, and that will probably boost up the economy of that country. So this is the underlying idea. Now, in the long run, again, the laws having been changed, that's what I said. When you look at the topics, very interesting, but it cannot be. Earlier on, it was a tax planning measure, I would say. Legally, you could do something. You could have this tax haven. You forget the money laundering part of it. If you had legal sources, you could park it and then have a lesser tax and bring it back in the normal channel to India and earn income. But today, government is very strict on funds like this, Mauritius or all these. They are very, very strict on all these things. So going forward, the law is so strict that especially when you are parking your funds, Government of India is very clear with the money, with the Black Money Act also in place. Any money parked outside India will have to be disclosed as if you are a resident. Now, that is the second subject that is being, second topic that is being dealt with. And we have the third one as an interconnection between the e-way bill, e-way invoice and the GST return. Now, GST law is one law which was resisted tooth and nail by most of the people in the country. All those who were doing legal business, it was fine with them. But as far as illegal business, India is one country which is such a large country. The parallel economy was as good or stronger than the regular economy. When I say parallel economy, a black money economy that was running in the country for a long time. I'm talking of those years when probably we had started our practice. Not today anymore. That was a time when, that GST coming in place. Now, once the GST was in place, now there are several improvements that are taking place in GST. Now, the idea is very simple. You look at it, the objective behind all this, for example, if you look at the objective behind e-invoicing or e-way bill would be probably to do, maybe for ease of business. That is what the objective would have been described as. But indirectly there is another side of the coin which says that by doing that, by making you enter everything in the portal, what really happens is government has got a track of all those things. So today, most of you who are filing income tax returns will be aware. Many of our clients, we tell them when they come and say that, these are the passbooks that you have, we will see the 26 AS or AAS and say that you have got 4 more accounts. Please bring all those statements also before I finalize your returns. It's a sort of transparency, or it's a sort of way that the government is able to access the information that you are having. So now when your bills and when you have an e-way bill or an e-invoicing taking place, everything gets into an automated mode. And technology, with slowly the limits also being varied now, everything is interlinked. So everything, when system becomes automated, what really happens is everything is captured in the system, and finally it has to go into your GST return, without which there will be a mismatch, and it will be easy for the department to detect all those misnorms that we are involved in. So that is the third, I would say, an intricate subject, but very interesting today, because that's the way forward as we see today. The business world, we have to all adapt to that. And as budding professionals, I think these three key areas are areas where you will be tested, whether you are in the industry or in practice, as you go forward. These are the areas that you will be tested. So with this introductory note, I would thank the organizers for coining these topics today for discussion. I'm sure with the interesting deliberations to follow, we would catch up some of the points and see how we can contribute also towards what they have prepared. With this introductory note, I hand over the mic back to the organizers for taking it forward.
Paper presenters, please pay attention. The first bell will ring at the end of 12 minutes. The second bell will ring at the end of 14 minutes. And the final bell will ring when 15 minutes have been closed. I repeat, the first bell will ring at the end of 12 minutes. The second bell will ring at the end of 14 minutes. And the final bell will ring when 15 minutes have been closed. Hence, please take note of the time limitations.
Our first presenter for the second day of EKATVA Mega Conference for CA students is Mr. Nizam KP, who hails from the district of Kochi and is pursuing his first year of articleship.
See, today I am here to talk about tax saving strategies. See, before I go ahead and talk about tax saving strategies, I'll tell you a story. So this happened few months back, where I had purchased a Royal Enfield Himalayan bike and I had to pay a tax of rupees 80,000. Isn't it so high? For a bike you pay a tax of 90,000 rupees? Yes, it is. It's so high. So from that moment onwards, I decided that I have to frame some strategies to reduce my taxes. So then I also got an opportunity to be part of making a salary structure for a company wherein my relative was a director. So by making a very good salary structure, I was able to reduce the taxes and help the employees to get higher earnings. So tax saving is just like weight losses. So in order to lose weights, you must do exercise and you must also reduce the calories. Similarly, if you want to reduce the taxes, you must use exemptions and deductions both put together will give you the tax saving. So what I'm going to do is, I'll talk about some of the exemptions and deductions and we will put together all of them. Then I will show you that how can you receive a gross salary of rupees 12 lakh and still pay zero taxes. Are you all excited? Yes, okay, let's go ahead. So the first exemptions I want to talk to you is house rent allowances. See, just take an example. Say you are a qualified chartered accountant and you are currently doing a job in Kochi. So what you do is you take a flat for rent, say a 2 BHK where you pay a rent around rupees 30,000. So annually you pay a rent of 3,60,000. So to claim the HRA exemptions, we have some conditions like HRA received annually, actual rent minus 10% of basic salary, then it is basic salary into 40 or 50% depending upon the city. If you are from metro city, it is 50%. If you are from non-metro cities, it is 40%. So if you do the math, you technically will get an HRA exemption of rupees 3 lakh. So what's the benefit of this? The simple benefit is that whatever is the gross salary, 12 lakh rupees you're earning, you can claim an exemption of 3 lakh. Now the taxable salary becomes 9 lakh rupees. So let's dive into the next exemptions, which is leave travel allowances. See, are we born only to work? No. We need entertainment, we go for trips and all of that. So for a normal person, what happened is, in a year we go for some trips and all of this. Just assume that you and with your parents have gone to Jammu and Kashmir, and for the flight tickets, for you and your family, I mean your parents, you both have incurred a expense of 50,000. That 50,000 you can claim it actually as an expense. Means you can actually claim it as an exemption. So thereby reducing your gross salary by 50,000. And this you can claim it in a block of 2 years. You can claim it in a 2 years in a block of 4 years. Now look at from the gross salary, our after claiming the HRA exemptions and leave travel allowances, our taxable salary becomes 8,50,000. And the next is children education and hostel expenditure, which is the exemption is 100 rupees per child per month, and it is hostel expenditure is rupees 300 per child and per month. And but there is a catch over here. It's available only for 2 children. Why I specifically tell it's 2 children? Because some of my friends were sitting there, they will misunderstand it, sir. Whatever Nizam is telling, to say we need more children. No, there is a catch of 2 children is there. Okay? So if you do the math, for a child put together, education and hostel expenditure, it comes out to be 4,800. And for both children, it becomes 9,600. So this 9,600, you can actually reduce from gross salary, making your taxable salary as 8,40,400. And the next is uniform allowance. See, when I say or talk about uniform, what comes to your mind is, okay, uniform is just like how uniform works in schools. Nothing like that. See, in company perspective, what really happens is that if you go to some companies, they have a criteria, it's like you can wear particular colors of shirts, and some kind of rules will be there where they don't clearly specify these colors, but they will give a bunch of colors, so you can choose it. So in that cases, what really happens that in our normal way of life, say just take an example, in a year, you take say 6 sets of pant and shirt, where it, just an example for purpose, I'll take for each sets you incur 5,000 rupees. For a pant and shirt, it's normal to incur 5,000 rupees. So if you calculate in annually, it comes out to be 30,000 rupees. So it is not just about only the uniform. It also includes maintenance and laundry. So if you talk it in a reasonable manner, we incur 500 rupees for laundry and all of this. So if you calculate on an annual basis, you get 6,000 there too. So annually for both uniform allowances, you have a total of 36,000 rupees, which is again we can get an exemption under the Income Tax Act, and we're making our taxable salary as 8,04,400. The next is reimbursement. So the first reimbursement we have is the meal reimbursement. When you hear the meal reimbursement, it's only 50 rupees per meal for 2 meals in a day. When you just think of it initially, what you feel is like, oh, it's very small amount. No, just assume that there is 5 days in a week, and a monthly days of 22, and monthly expenditure becomes it is 2,200. So annually you will be able to claim 26,400 rupees. So this also you can use an exemption and reduce your taxable salary, and you can save a lot of taxes in that. So if you do the math, again we will deduct 26,400, making a taxable salary of 7,79,400 rupees. And it is not just meal, you have internet, then you have mobile recharge, all this is you can claim as an exemptions. Then gratuity is also there, where if you receive the gratuity, it is exempt in the tune of 20 lakh rupees. And you have this leave encashment. What is this leave encashment? It's nothing but some people, what it does is, during leave days also they work. and they get paid, they get encashed with that. And that is also exempted in the tune of 25 lakh rupees. So, this is the crux of this discussion, which is nothing but the salary structure, which I was talking in the beginning. So, it all depends upon the salary structure, how you structure your salary. I have initially told that I was involved in making a salary structure in my relative's company, where, see, what I have done is, I told them that instead of showing or instead of giving the entire 12 lakh or entire 10 lakh as salary, just give them a basic salary and provide them with many allowances so that they will be able to claim the exemptions. That is where it makes a big difference. Instead of, see, what happens is, for a company it's neither a loss, because anyway they are paying 10 lakh. So instead of paying them that, instead of they paying entire 10 lakh as salary, they pay some as basic and they pay other thing as a allowances, in which the employees are able to claim exemptions and they are able to save very, very huge amount of tax. So as I promised in the beginning, I am going to show how can you receive a gross salary of 12 lakh rupees and still you can pay zero tax. Now we go ahead with the deductions. You all know, first is the standard deductions of 50,000. Then another is professional tax deduction, which is 2,500. Everyone knows it. Then we have the ATC. ATC is very good deduction where you can claim a deduction of up to 1,50,000. This includes your LIC premium. This includes employee provident fund, public provident fund, and all of this. And this also includes your housing loan repayment. And this also includes your payment of tuition fees and all of this. There are a bunch of investment which is covered over here. And what is biggest thing is that is all our investments. And you can also claim exemptions for the same. Or you can actually deduct it from the salary. So another thing is ATD. See, we all know that, see, in a year, we usually take a medical insurance, no? Or if you have your parents also, you take a medical insurance. So, what is the limit is 25,000. That is including you or your spouse, or it can also comes under your children or parents who are dependent. And if you just think you have a parents who is a senior citizen, and you can actually claim an exemption, or you can actually claim a deduction of 50,000 rupees. And another thing is that, see, in a year, we usually go for medical checkups and all of this, which is quite natural. But what really happens is, none of them is aware of that. This we can actually claim it as a deductions. And this, in this case, is the cash payment also being covered over here. Then 80CCD 1B. This is very interesting. Why it is so much interesting is, this is the investment or the contribution that we make towards the national pension scheme, and you can claim an additional deduction of 50,000 in addition to the 1,50,000 which we already looked into ATC. Now the magic comes, or now what I have promised, I am going to show you this. So the gross salary of rupees 12 lakh, from there we are claiming an exemption of HRI allowances, and from we are claiming a leave travel allowance of 50,000, and children and hostel allowance of 9,600, and meal vouchers of 26,400, and uniform allowance of 36,000, and taxable salary becomes 7,79,400. From there you are claiming a deduction of standard deduction of 50,000 and a professional tax of 2,500. Then you have further fewer deduction like 80C, which we already covered, and 80D of 30,000, which includes 25,000 for medical insurance and 5,000 for medical checkups. And you have come 80CCD 1B of 50,000, thereby making a net taxable income of 4,99,400. That means you don't pay even single rupee as tax. It is fully. That means you won't be able to pay, you are not required to pay a single rupee as tax. So whatever I have promised, I have shown with the calculations. This is how, and we also have many deductions. But I have particularly chosen this to show that, yes, it's possible that even if you receive a 12 lakh rupees of salary, you can still pay zero tax. And another thing is, we'll further extend it. So just assume that you receive a gratuity of 50,000. I have seen recently Paytm company paying gratuity. So what really happened is this entire thing is exempted. You don't need to pay tax on that, and a leave encashment of 25,000. So just thereby increasing our gross salary to 12,75,000, still you can pay zero tax. So and you have to remember all of this. This is all without loan. So this is all without loan, okay? This is all calculation I have made without taking a loan. So if you take a loan and you have any, if you are paying interest, this you can actually claim it as a deduction under section 24B. So this is also being covered. So that's all about the tax planning strategy. It is just a small strategy which I have prepared, and it is, one conclusion I have made is this is a very small strategy which I have prepared. This can be, there are a lot of further scope, a lot of further things which can add up, and actually you can pay a zero tax on this. So thank you for listening patiently, and that's all.
Thank you, Nisa, for an insightful session. Our second presenter for the day is Ms. Liana Fersi. She hails from Kochi and is currently doing second year of articleship. Second topic is tax havens and offshore financial centers in international tax planning. Our topic is one that delves into a fascinating and often complex area of international finance. This session will explore the roles of tax havens and offshore financial centers, their implications for international tax planning, and how they can be utilized legally and ethically. Tax havens and offshore financial centers are often associated with strategic tax planning, offering opportunities for tax efficiency and financial privacy. However, navigating this landscape requires a deep understanding of international tax laws and regulations. We welcome Ms. Liana Fersi to the stage to provide us some insights on this topic.
Respected dignitaries on and off the dais, and my dear friends, a warm good afternoon to one and all present here. Before getting into my presentation, I would like to ask you a question. That, have you heard about the world's biggest data leak? It is the Pandora Papers. 12 million documents, 29,000 offshore entities and trusts, and around 300 Indians were named in these papers, which ranged from Sachin Tendulkar to Nirav Modi. Interesting, right? And you might be wondering, what was this leak about? The Pandora Papers revealed how the high net worth individuals and multinational corporations, how they reduce or avoid their taxes. And here comes the relevance of my topic, tax havens and offshore financial centers in international tax planning. I welcome you all to my presentation. So, what are tax havens? They are basically countries or jurisdictions that offer favorable tax treatment to individuals and businesses. They typically offer low or zero tax rates. So, what are offshore financial centers? Offshore financial centers or OFCs, they are, as defined by Ahmed Zarom, refers to countries or jurisdictions that offer financial services to non-residents on a scale which is incommensurate to the size and the financing of its domestic economy. These centers facilitate wide range of financial activities to non-residents such as banking, insurance, investment management, wealth management, and so on. And you know, there are numerous tax havens and OFCs across the globe, which include the Cayman Islands, the British Virgin Islands, Panama, Mauritius, and so on. Now let us delve into their characteristics. So besides providing favorable tax regime to individuals and businesses by way of low or zero tax rates, they also provide strict financial secrecy. Here we're not talking about financial privacy. Financial privacy means to keep your financial affairs to yourself or to your bankers or to attorneys. But even though there is some sort of openness that the regulatories and the tax authorities, they can access them in certain events. But on the other hand, financial secrecy means no one will ever know what you have except you and your banker. So making it even more challenging for the tax authorities and the regulatory bodies to get access to the true information about the transactions that are happening, about the true ownership. Also, these tax havens and OFCs, they lack transparency due to opaque financial systems with limited reporting requirements. And many entities in these tax havens and OFCs, they may lack real economic activity or real physical presence. They may only exist in papers for the purpose of availing the benefits which these jurisdictions provide. That is another concept called shell companies. So basically these are the factors or the features which attracts these big shows to tax havens and OFCs. So now let's see how do they work. So one of the biggest methods, there are numerous ways by which the businesses avoid taxes by using tax havens. And one of the biggest methods by which so first let's talk about corporate profit shifting. And one of the biggest methods by which these multinational companies avoid taxes by using tax havens is through corporate profit shifting. So this is where the business registers its headquarters in another country having low taxes. For example, in UK the corporate tax is 25%. If it moves its business, that is the headquarters, to Switzerland, there the corporate tax is only 8.5%. And the difference would be even bigger if you move your headquarters to, say, the Cayman Islands, where the corporate tax is only 0%, and thereby substantially reducing a big tax bill. This isn't a rare occurrence. In 2019, nearly 2/3 of the profits of these American multinational companies were booked in just 6 low or zero tax countries. And another technique which these big shots use in order to avoid taxes, to move their assets, high valuable assets such as the patents, algorithms, formula, codes, to outpost in low tax jurisdictions. For example, a US business could move its patents to Ireland, a low tax location, and now this asset belongs to the Irish subsidiary, at which point the Irish subsidiary could now charge the US business to access these patents, allowing them to easily funnel the profits from US to Ireland by way of passing them as payments for the the patents. And by doing so, now the profits belongs to the low tax jurisdiction, and also it helps to substantially reduce your tax bill. Individuals could also do a similar thing. Becoming a resident of a country having low tax is one method which the individuals use to reduce taxes. However, there are also other methods which allow them to reduce taxes by residing in one country while paying taxes in another. And this is done by using trusts. So this technique allows these people to put their assets in within a tax haven, within a trust in a tax haven, and they will be managed by trustees. And still these individuals will have full access to all these assets. They can still use them, they can still own them. But technically speaking, it will be managed by the trustees and it will be under the trust. So, which will enable him to be out of his native government's remit and the tax implications there. Now the question is it illegal to do so? For that, we'll have to understand the difference between what is tax avoidance and what is tax evasion. Tax avoidance means to reduce your taxes by using the legal deductions and exceptions, and hence it is legal. Whereas tax evasion is to reduce your taxes by committing illegal activities such as fraudulently underreporting income, concealing assets, and so on. So, using tax havens and OFCs to reduce taxes is not always illegal, but at times these tax havens and OFCs are used to park money which is out of criminal activities like money laundering, drug dealing, human trafficking, terrorist activities, etc. So it depends upon individual circumstances as to whether it is legal or illegal. So the following are the mechanisms and the policies for addressing the challenges which are posed by these offshore structures for illicit purposes. So first is global minimum tax. Global minimum tax, or GMT, it is a major step forward in international cooperation on taxation of these multinational enterprises. So this aims to change things in two ways. That is, first, the companies will have to now pay taxes in the country in which they operate and not the place where their headquarters are. And also it implements an effective minimum rate of 15% on the corporate profits of these multinational companies like the Apple, Microsoft, Google, etc. So this is going to reduce the effect of corporate profit shifting. And next is the Double Taxation Avoidance Agreement, or DTAA. It is a treaty which is signed between two or more countries. And DTAA, its main objective is to enable the individuals to get relieved from being taxed on the same income. So DTAA does not enable them to completely avoid the taxes, but instead it will help them to get relieved from being taxed on the same income. And finally, multilateral convention to implement tax treaty related measures to prevent base erosion and profit shifting, to simply say BEPS MLI. So it is an outcome of OECD or G20 BEPS project that swiftly implements a series of tax treaty related measures to prevent base erosion and corporate profit shifting. So it actually allows the governments to easily update or modify their existing bilateral tax treaties instead of renegotiating each of them. To wrap things up, the landscape of tax havens and offshore financial centers is a complex tapestry woven with opportunities and challenges, making for the global economic actors. So while we navigate through the intricacies of international tax planning, let us remember the words of Benjamin Franklin, who said, "In this world, nothing is certain except death and taxes." Today, we must also consider the evolving landscapes of regulatory frameworks and ethical dimensions that shape our choices. So let us strive for transparency, fairness, and responsibility in our pursuit of global prosperity. Thank you all and have a nice day.
Thank you, Ms. Liana Persin, for the wonderful session. Our third presenter for the day is Ms. Chandana S. Nair. She hails from Kochi and is pursuing her first year of articleship. Her topic is the interconnected world of e-way bill, e-invoice and GST returns. This session will provide an in-depth look at how these three critical components of India's tax system are interrelated and how they work together to streamline business processes and ensure compliance. The implementation of e-way bills, e-invoices and GST returns has revolutionized the way businesses operate, offering greater transparency, efficiency and accuracy in tax reporting and logistics management. Chandana S. Nair to provide her insights on the topic.
GST is not just a tax reform, but it is a step towards economic reform. A highly profound statement by our Honorable Prime Minister, Shri Narendra Modi. And time proved that this statement is indeed very, very true. Honorable dignitaries on the stage, eminent personalities, ladies and gentlemen, a very good afternoon to all of you. I would like to begin by asking you a simple question. Is there anyone here who has not paid GST even once? Or he or she is not willing to pay GST simply because he or she doesn't like to pay GST? Do we even have an option like that? No. And that is the power of GST. To pay income tax, you need to earn some income. But GST law has no such partiality towards us. Even if you like or you don't like, you have to pay GST. Even if it is a 5-year-old kid, it is me, you or Sri Ambani ji makes a taxable supply which comes under the purview of GST, they are liable to pay GST. So, without any doubt, we can say that the introduction of GST in India has been a transformative reform, significantly altering the country's economic landscape. By creating a unified market, a simplified tax structure, improved compliances and revenue collection, reducing the effects of tax cascading, GST has laid the groundwork for a sustainable economic growth. And another interesting point is about revenue. Can anyone say how much GST contributes to the revenue of our nation? Yeah, it's a huge amount, but let me help you with this. According to the interim budget reports of 24-25, 63 paise of every rupee in the government treasury comes from direct and indirect taxes. And among indirect taxes, GST is the key contributor, accounting 18 paise for every rupee in the government treasury. This proves that GST is a vital source of fiscal income, supporting various developmental and welfare projects all along the nation. And as CA students, we know that before the introduction of GST, for people doing businesses, life was little difficult. Now you would be asking me, how? Why? For that, let me take you all along with me for a small ride through the life of Mr. Lolapan. Now you would be wondering, who is Mr. Lolapan? Lolapan is an ordinary man, an ordinary vendor who is based in Palarivattam, dealing with trading of crockery items, both in wholesale as well as retail. He is one of the key wholesale distributors in Kerala. And for that, he imports items from countries like China, Italy, Germany, and he even makes purchases from various parts of India. So, before the introduction of GST in India, he has to comply with several tax laws like VAT, customs, sales tax and whatnot. And even after complying with all the tax laws, there used to exist some problems with one or the other tax filings. And this was not only the condition of Mr. Lolapan, but people who did business in India. So, the introduction of GST in India was a very good news for Lolapan. Because what was the motto of GST? One nation, one market, one tax. And for people like Lolapan, he thought, okay, to comply with one tax law, one filing, wow. But as amazing as the concept of GST lies, its implementation came with its own difficulties. And finally, GST law was implemented in India, and now our Lolapan came running to his chartered accountant, Mr. Ranga, and told, sir, finally GST law has been implemented. Now what should I do? So he explained, Mr. Lolapan, now you have to file GST returns. He asked, GST returns? What are GST returns? GST returns are periodic statements that businesses registered under GST regime in India are required to file with the tax authorities. And there are different types of GST returns. And some of the common GST returns are GST return, GSTR 1, which gives details about the taxable supplies made by the taxpayer. GSTR 2A and 2B, which again gives details about the purchases made by the taxpayer. GSTR 3B, which is a summary return of the sales and the input tax credit availed by the taxpayer. GSTR 9, it is an annual return which summarizes the entire year's sales transactions. Then you have the GSTR 9C, which is a reconciliation statement which is to be filed by taxpayers above a certain threshold limit. Now, our Lolapan thought, okay, so the process is simple. My accountant will hand over the invoices to the tax filing agency. They will enter the data, GST returns filed, everything is so easy. But no, again, this easy process became a nightmare because many times the accountant used to miss to hand over the invoices to the tax filing agencies, and on the other hand, sometimes the agencies who used to file used to miss some invoices, enter the incorrect figures in the GST portal, and there used to be huge differences between the sales figures reported in the GSTR portal and the sales in the book. Now what to do? But in spite of the initial challenges, GST made some technological advances. The GST system brought some technological advancements, and finally in 2018, e-way bill was introduced in India. Now again, our Lolapan came running to the chartered accountant and asked, sir, e-way bill. Now what is e-way bill? So, e-way bill is a document that is required to file or required to generate for transporting goods worth more than rupees 50,000 within India. And it is generated electronically on the e-way bill portal. So, GST registered persons, they cannot transport goods without generating an e-way bill if the value exceeds rupees 50,000. And even if for some supplies, even if the value is less than 50,000, the e-way bill is required to be generated. And even unregistered persons, they also have to generate e-way bill. But if they are making supply to a registered person, then the receiver will be responsible for generating the e-way bill. So, while generating the e-way bill, an e-way bill number will be allotted to the person. And the e-way bill consists of two parts. Part A containing the following details and Part B which consists of all these details. So, in simple terms, how the e-way bill works, first the e-way bill is generated by entering the details in Part A and Part B. So, once the e-way bill is generated, it is validated, it generates a unique e-way bill number. Now, after that, the tax authorities can verify the goods in transit, and the validity of the e-way bill depends on the distance covered by the vehicle. Again, the troubles did not end here because again we are doing manual data entry. And finally, in 2020, e-invoicing was introduced in India. What is e-invoicing? E-invoicing means generating electronic invoice. How? So for e-invoicing, the GST registered businesses, certain notified GST registered businesses, they have to generate e-invoices for B2B transactions and few other transactions which will be electronically authenticated by the GST portal. And you might be thinking, what is the speciality of e-invoicing? In e-invoicing, the invoices will be allocated a special number by the invoice registration portal, which is managed by the GST network. So all the invoices details will be transferred from the e-invoice portal to the GST portal and the e-way bill portal. This means that this reduces the need for manual data entry. So the trio, e-way bills, e-invoices and GST returns. So before the introduction of e-invoices, the businesses used to generate invoices using some software. Then these were manually entered to file the GSTR returns, and again they had to be manually entered to generate e-way bill. But with the introduction of e-invoicing, these all three were interconnected. So under the e-invoicing system, the invoices were generated in a specified electronic format from the taxpayer's accounting system. Now, these e-invoices will contain data which will seamlessly flow for the generation of GSTR1 and e-way bills. So once the e-invoicing is validated, the details required for the part A and part B of the e-way bill will be auto-populated. So now this is the life of Mr. Lolapan after e-way bill, e-invoicing and GST returns were interconnected, because this interconnection came with its own advantages. The first one, data integration, because now the data was auto-populated from e-invoicing to the GST portal and the e-way bill. There were less chances of missing out. Second one, accuracy. Because of the automated input of the invoice data, there were reduced chances of manual errors. Effectiveness and compliance. There were less chances of duplication and there was more consistency with all the documents. And reconciliation. Now businesses, they were able to reconcile everything with the e-way bills, GSTR1, and this interconnection was truly helpful for the traders as well as the government. So the interconnection of the e-way bill, e-invoices and GST returns created a comprehensive digital audit trail which helped to curb the tax evasion, and an automatic matching of sales and purchases. This also helped in reducing the chances of tax evasion. So e-invoicing plays a key role in the interconnection of the e-way bills and e-invoices and GST returns, which facilitates a seamless exchange of data along the three platforms. I hope you got some insights about this topic. Thank you so much for your cooperation. Have a great day.
Thank you, Ms. Chandana, for such a brainstorming session. Now, I request our session chairman, C.A. Krishnan S., to give his insights upon this session and guide us better.
You will all agree with me that it was a wonderful presentation by all the three. I give them a very big hand. Nizam beautifully explained how earning 1 lakh per month still you could get away by not paying any tax. But I think he took a lot of assumptions in that. For example, his assumption mainly was that you as an employee had the liberty to decide which way you can structure your pay. But in reality, that does not happen. For example, you go to a company, very few companies, probably software does it because they want the people, but not all companies give you that freedom to choose a way you want to evade the tax, or minimize the tax. So that's one problem that probably we'll have even when you get 12 lakhs. We cannot think that everywhere we are going to get away with the tax structure. We have the freedom to do that, it's fine. And of course, in my introductory remarks, I also said that with deductions going, I think vis-a-vis the tax rates, new tax rates that are attractive. Because at 12 lakhs, probably you will be better off by adopting for the new regime, where the tax rates could be little less. So the deductions are of an old regime. So we are shifting into a new regime, and of course, very beautifully presented, let me tell you, because there are so many options that, which one can explore if you are given an opportunity to reduce your tax burden, where, you could explore all those possibilities. But then, going forward, I think in the years to come, we may probably be doing away with the old regime. So when that be the case, the deductions, as I told you in the introductory remarks, our planning itself goes for a toss because there is no scope for planning at all. But having said that, wonderful, because that examples all those things, I think big hand to Nizam for what he has done. Now, Liana, I think she took us to the tax havens. The way she presented, I think it was a little flying to those tax havens as if you were there. Very, very beautifully scripted, let me tell you. The PPT was excellently done and made it very simple and understanding for people. For somebody watching, and of course she did explain about what a tax haven is and what multinational companies are doing, and to reduce the tax burdens. But then now things are not as simple, because having taken cognizance of what is happening now, with the signing of G20 and OECD in place now, it is not like all those tax havens or the creation of the shell company. The government of India itself has come down very heavily on shell companies. So that is also going to be a thing of the past. But for the time being, still there are a few countries that are offering these low tax rates or zero tax rates, which are still being taken advantage of by the Indian companies or other companies from the other world. Again, a wonderful presentation, let me tell you. Overall, she had covered that, and the presentation, the manner in which it was explained to the audience was also very excellent. A big hand to her also. The last of the presentation was on the e-way bill by Chandana. I think I always felt that, to make people understand that Lonapan was very useful. We talk about the way you present a thing, it must be appealing to the others. GST generally is a very dry subject. To be concentrating on that, very, very interesting, because a lot of demands are coming for chartered accountants. The practice area, it is very interesting. But when you're giving example, when you're creating a person, and then the way she presented it, running from one person to another, all those things were like as if it was a live example that was being demonstrated to you. And of course, she took off by saying that what Lonapan did when the GST regime was introduced, and then taking off suddenly when the e-way comes. That's a situation where all of us panicked because the clients came rushing to us. What do we do now? So there, the transition, the way he had to take it forward and explaining all those intricacies of those, and the interconnection between invoices and the benefits, like, part A and part B, what those meant, going into the nitty-gritties. I think that was also wonderful. The big hand to Chandana also. I think all of them have done exceedingly well in the topics given to them. Absolutely, very, very, very painstaking effort taken by them in preparation of the PPT as well as in delivering what they have done. I think for those who are those who are here, I think it should be a motivation for you, at least in the next conference, or going back to your branch or between the students. I think one small topic you should take, and then you should take it from here. Because, we want more people doing this. That's how you also improve your skills. And one thing, let me tell you, for all the students, when you start preparing a PPT, you will realize that what you otherwise thought that you were knowing so many things, when you really prepare a PPT, you will start knowing that you don't know anything. And I wouldn't say you don't know anything, you know something, but there is always a scope for improvement. So I think for those who have been a little shy in doing this, I think it's a great opportunity for you, and that's what you learn from these conferences. Go back and then try to do everything and pounce on any small opportunity. If there is no audience, do it at your house in front of your people. I think that will give you a lot of confidence. Anyway, I think summing up, it was a great session. As I told you in the beginning, all the three topics are little dicey, I would say. I will not say complicated topics, but you are changing. The transition is probably making all those topics a little redundant. Maybe walking down the line 5 years from today, there may not be any relevance. But today, they are all occupying a very vast, probably e-way may get a little more expanded in some other way. But the way the government is tightening things, and e-way bill and e-invoicing, basically, she touched upon saying that, it is for the ease of operation. But it is not only for the ease of operation, but as I told you, the government wants a full check on all the movement of goods here. I will ask you one question. I don't know how many of you have noticed. I have noticed. I think I am right. I am not sure, but I thought I'll get it confirmed from you. Before the GST, we found a lot of vehicles of the commercial tax department intercepting most of the goods that were going. Today it's still there. I am not saying it is completely gone. But today, comparatively, the notices that are being issued to the assessees are not by way of an inspection or stopping the vehicle on the way. It is something that is coming from the portal and all those things that you are being subjected to. That means the government, there is a paradigm shift in the government's approach, that they go into some other technology-driven method by which they will tackle or combat tax evasion. So to that extent, I think all these measures from the government, all these topics are of great relevance. Once again, a big round of applause to all the three who have handled this very well, and to the organizers for having thought such topics also. I think with this concluding remark, let me congratulate you and wish you all the best, all the three speakers, for a wonderful tenure, to qualify fast and then achieve great things in your life. Thank you so much.
Thank you, sir.
So good afternoon all. The most difficult part in my life was clearing CA exams. The second most difficult was judging this event because all three performed equally well on three different topics, and I had been given three criteria and each of them excelled in each of these criteria. So that's very difficult. So that was so round of applause for all three. And first one, Nizam, so your presentation was very good. The way you took off the presentation, the way you traveled through the presentation, the way you landed the presentation, everything was fine, very good. And Liana, your presentation was world class. Okay. I genuinely felt jealous, seeing that presentation. I was like, yeah, that should have been my presentation, not yours. So that's very good. And Chandra, your content was very good. The real life examples sir had mentioned, that we could relate it to the topic. So that's my closing remarks for this session. And I would like to thank SICASA EKM for giving me an opportunity to share the stage with Krishnan sir. And I hand over the mic to our organizers for further proceedings.
Thank you, sir. May I invite our session chairman, CA Krishnan S, to felicitate our paper presenters for the session with a memento. Sam KP. Miss Liana Fursing. Ms. Chandana S. Nair.
May I invite CA Rupesh Rajagopal, Chairman, Ernakulam branch of SICASA of ICAI, to felicitate our session chairman, CA Krishnan S., with a memento as a token of our appreciation. I also request CA Rupesh Rajagopal, Chairman, Ernakulam branch of SICASA of ICAI, to felicitate our judge for the session, CA Deepak V., with a memento as a token of our appreciation.
Thank you. With that, we come to the end of our technical session 3, direct and indirect tax laws. May I request CA Krishnan sir to award the winner of our second technical session, Audit and Law, which was yesterday. The session was chaired by CA Dr. Durgesh Pandey. We also had CA Revati Raja as our judge. Let us put technical session 2, Auditing and Law. Mr. Fleming Joseph. A huge round of applause to Mr. Fleming Joseph. He's the winner of our second technical session which happened yesterday, Auditing and Law. Thank you.